Okay.
You see it trending on social media. Financial news outlets are talking about it nonstop. And even your friends and family are saying, hey, have you heard about this stock?
So there's this widespread positive buzz.
Exactly. And that can create a powerful sense of FOMO, fear of missing out.
Right. Everyone's thinking, I don't want to miss out on this potential gold rush.
Exactly. And people who hadn't even considered investing in that stock suddenly feel like they absolutely have to get in.
So they jump on the bandwagon.
And all that buying pressure drives the price up even further, which reinforces the dominant decision to buy.
It's like everyone's rushing to get in on the action.
And the opposite can happen too when fear takes over.
Right. So if there's some bad news about a company or the overall market starts to decline,
Panic can spread very quickly,
people start selling their stocks, not necessarily because the underlying value has changed.
but because they see everyone else selling and they're afraid of losing even more money.
So it's this herd mentality again, but this time it's driven by fear.
Right, and that fear can lead to even fundamentally sound assets dropping significantly in price.
It's like a self-fulfilling prophecy.
In a way, yeah.
Okay, so we've got these powerful waves of buying fueled by optimism and waves of selling driven by fear.
Often overriding any kind of logical analysis.
But here's where it gets really interesting. The sources point out that after reaching those extremes of crowd sentiment, those trends often reverse.
They do. It's like a pendulum swinging back and forth.
Why does that happen?
Well, the logic is pretty straightforward. Think
Yeah.
about it. If everyone who's going to be bullish on a particular asset has already bought in who's left to keep pushing the price up.
Right, it's like reaching a saturation point.
Exactly. The pool of potential new buyers has dried up, so the buying pressure starts to weaken, and the price is more likely to fall.
And the same thing happens in a bear market.
Once all the people who are going to sell have sold, the selling pressure decreases.
So even a small amount of buying can start to push the price back up.
Right. It's like a rubber band that's been stretched too far. Eventually, it has to snap back.
That makes perfect sense, but the million-dollar question is knowing when that snap is going to occur.
Ah, yes, timing the market. That's the holy grail, isn't it?
Exactly, and the sources talk about how difficult it is to time those reversals perfectly.
It is very challenging because there are so many factors at play.
So what are some of the key things that influence how long a trend might last and when we might expect a change in direction?
Well, the material highlights three main factors. The first is information circulation.
Okay.
So how long has the narrative supporting the current trend been circulating? How widely has it spread?
So if there's a hot news story about a company or a new technology,
That can attract a lot of new investors and keep the trend going for a while.
but eventually that information becomes less novel, less impactful.
Exactly. And the influx of new buyers or sellers starts to dwindle.
So the initial excitement wears off.
And the trend becomes more vulnerable to a reversal.
It's like a fad that eventually fades away.
The second factor is market sentiment shifts.
Okay.
So even while a trend is still in full swing, you'll often start to see some contrarian viewpoints emerging.
People questioning whether the trend can really continue.
And as more and more people start to have doubts that can erode the strength of the dominant trend,
So it's like cracks starting to appear in the foundation.
and that makes it more likely that a reversal could happen.
Got it. And the third factor.
That would be external catalysts.
What are those?
These are those unexpected events that can come out of nowhere and completely change the game.
Like what?
A surprise economic report that's much better or much worse than expected. A sudden geopolitical event. A new government regulation.
Things that can really shake things up.
Exactly. And these catalysts can either accelerate an existing reversal or trigger one that nobody saw coming.
So it's almost like trying to predict the weather. You can look at the patterns and make an educated guess, but there are always those unpredictable elements that can throw things off.
That's a great analogy. You can never be 100% certain what's going to happen.
Right. So understanding crowd behavior gives us a general sense of the market's direction, but timing those reversals precisely is a whole other challenge.
It requires paying close attention to all those subtle cues, the flow of information, the shifts in sentiment, and those potential external catalysts lurking around the corner.
So it's not just about reacting to what's happening right now. It's about anticipating what might happen next.
Exactly. It's about reading between the lines of those price charts and news headlines.
Okay, so we've talked a lot about the crowd's emotions, but let's shift gears and talk about our own emotion.
Our own internal landscape.
Right, because as much as we try to be rational actors in the market, our feelings can definitely get in the way.
Oh, absolutely. I mean, we're human beings, not robots.
And the sources really highlight the importance of emotional intelligence when it comes to trading.
It's crucial.
So what does that actually mean for a trader? What does emotional intelligence look like in action?
Well, it starts with Being aware of your own emotional state.